The fragile ceasefire. Why the global economy remains on edge. A tentative ceasefire between the United States and Iran has triggered a sudden surge in stock markets and a sharp drop in oil prices. However, beneath the surface of this brief relief, the global economy remains precariously balanced. While the immediate threat of a massive market crash has receded, the underlying geopolitical tensions and the disruption of vital energy corridors suggest that stability is far from guaranteed. The illusion of stability on Tuesday night. Markets reacted with relief to news of a ceasefire agreement intended to pause American military operations in exchange for the reopening of the Strait of Hormuz. The impact was immediate. Oil prices plummeted by as much as 20%. The Dow Jones Industrial Average jumped over 1,000 points. Despite this optimism, the reality on the ground is far more complex. Reports indicate that transit through the strait has not yet fully resumed, and military activity continues in the region. Israel has reportedly continued strikes against Iranian proxies in Lebanon, and Tehran has accused the U.S. of violating the terms of the agreement, labeling ongoing negotiations unreasonable. The leverage battle. Why the strait matters. The Strait of Hormuz is often described as the aorta of the global hydrocarbon market. It is the narrow, critical waterway through which much of the world's oil flows from the Persian Gulf to global markets. The current standoff is essentially a high-stakes game of leverage. The U.S. position. Washington seeks a ceasefire and the reopening of the strait to prevent a global recession and stabilize domestic energy costs. The Iranian position. Tehran holds the on-off switch for global energy. For Iran, maintaining control over the strait is its most significant piece of geopolitical leverage. Relinquishing control before a durable, permanent agreement is reached would mean forfeiting its primary bargaining chip. Economic scenarios. Optimism versus reality. The path forward presents two very different futures for the global economy and the American consumer. The moderate recovery scenario. If negotiations lead to a functional peace deal, the world may avoid the worst-case outcomes. However, even a successful deal will not return the world to normal overnight. Supply lag. Because Gulf states had to scale back production while the strait was blocked, it will take weeks or months to restore pre-war supply levels. Refining bottlenecks. While crude oil prices have fallen, the cost of downstream products like diesel and jet fuel remains high due to damage to refining and petrochemical facilities. Consumer impact. This scenario likely prevents $6 per gallon gasoline, but energy-related costs will remain elevated for some time. The demand destruction scenario, the worst case. If the ceasefire fails and the strait remains effectively closed, the global economy faces a catastrophic supply-demand gap. Price spikes. Experts warn that crude oil could soar to $200 per barrel. Demand destruction. When supply cannot meet demand, prices must rise so high that consumers are physically forced to consume less. This is known as demand destruction. Global divergence. While the United States is relatively energy secure and might see a localized boom in oil-producing states like Texas and New Mexico, the rest of the world faces a grimmer reality. The Global South would likely face outright energy shortages, potentially triggering a global economic depression. The bottom line, the current ceasefire has provided a much-needed breather for Wall Street, but it has not solved the fundamental crisis. The global economy is currently caught between a fragile diplomatic process and a volatile energy market. Until the flow of oil through the Strait of Hormuz is both predictable and secure, the threat of a deep recession remains a very real possibility. Conclusion. The market's recent rally may be premature. While the ceasefire offers hope, the true test lies in whether a lasting agreement can be reached that restores the flow of energy without forcing one side to surrender its strategic leverage.